Welcome back, folks, to the second installment of the complimentary lessons, which I will be releasing over the course of the next few weeks and maybe months. Now, these complimentary lessons are primarily geared to the aspiring traders who wish to learn how to really trade and learn how the markets really work. Now, these lessons are also meant to be a supplementary lesson for my mentees as a way to complement the lessons that I teach to them in my private mentorship program. Now, a lot of you know that I come from a legal background. I was a lawyer before, and I also have a master's in anthropology, specifically visual anthropology. I did not come from a finance background. I don't have a CFA or any of the qualifications that one might have as a trader traditionally. So a lot of the topics that I cover here, especially in the topic that we're going to be covering today, are meant to give you a better context in how to understand price and how the markets really work, right? And it's a way to understand price from a different standpoint, right? From a perspective of a lawyer and someone who has a master's in anthropology. This is how I look at price and the markets, and this is how I approach it as a whole. It may be giving you a different perspective of price and the markets that is distinct from what you usually come across typically in a trading class or platform that is typically given by finance inclined professionals or traders that are already trading in the industry. Now, this is how I approach it, okay? And it's meant to prime your mindset towards being a professional-minded trader, okay? And a lot of the things that we're going to be looking at today actually goes against the grain of the majority of today's standards of trading. Now, I inspire to give you a higher level of understanding, and I want to give you attention and bring your attention to trading as a fine craft. And like fine crafts, they're done by craftsmen. And if you're a craftsman, you have a high levels of standards and excellence. Okay, so a lot of what we're going to be covering today in this presentation, we'll be looking at a lot of key concepts that will give you context in order to frame your understanding of price and the markets. And again, this is how my mind works, but I highly encourage you to adopt a similar perspective, as it will give you a richer understanding of price and markets and how the industry works. And you will find that having this sort of knowledge, which is historical in basis, is anthropological in basis, it uses critical thinking as opposed to mathematical thinking, it will give you a deeper understanding of how price and markets work. Okay, and one last word about coming from a different type of background. In my early days, when I was learning how to trade and doing your research into the materials that were present or available to you, as one might do, you would try to go and look for people or successful people that are traders and you tend to look at their background. I mean, most people would just look at people like Warren Buffett, typically. But what I did was I started looking at people like George Soros. And if you look at George Soros, you'll see that the core philosophy behind his trading methods and his method of investment is rounded around the concept of reflexivity. And reflexivity is a key concept in anthropology. And that sort of led me to believe, or led me into a different kind of path where it sort of confirmed my beliefs that you don't really need to be a mathematical wizard or have a degree in quantitative finance or accountancy and so forth. Things that are typical if you wanted to enter into this industry and gain employment as a trader. Because at the end of the day, as traders, what we want to do is be making money, right? And in order for you to become a trader employed at a hedge fund, for example, that's all well and good if you want to do that. That's something that I also want to do. But for the purposes of this lecture, I want to point out that knowing that one of the greatest traders and hedge fund managers out there, George Soros, he does not even consider that as even remotely important in the way that he looks at the markets and price. His core philosophy is centered around a concept that is used and central to anthropology, which is reflexivity. Okay, so bear in mind that whatever that we're going to be covered today, if you come from a math-oriented, typical trader qualifications oriented background, and if you find any of this stuff, stories or you know, tall tales or boring, or you don't think it's necessary to trading, I can assure you that you're wrong. Okay, you are wrong, because a lot of these things that we discover throughout this lesson is actually a core characteristics of understanding price and the market as a whole. And why is that important? Ultimately, it makes us better traders, and it gives us a different kind of edge over every single one of market participants that are out there. Okay, so in today's presentations, we're going to be looking at what I call the basic tenets of trading, which is liquidity, efficiency, and price. Now, I want to start from the very beginning, and I don't want to spend too much time on this. I just want to punctuate the point of liquidity, price, and market efficiency. How did it come about, those concepts? Well, in order for us to uncover those concepts, we need to look at how the futures exchanges came about, its early history, and the markets that were present at the time. Now, during the 19th century, or late 19th century, we saw that there were agricultural challenges, which eventually led to the futures market. Now, there's different types of future contracts, right? There's future contracts that's exchanged and publicly traded on an exchange, There's futures contracts that are swaps or over-the-counter trades, and there's other kinds of future contracts which I won't cover too much in detail here. But the reasons for having these different types of futures market was due to seasonal supply fluctuations, price instability, and having a disorganized markets. These were the reasons that led to the creation of a futures market. Okay, and at the time in the USA, at the turn of the century, we saw a primitive method of storage of goods, and because industrialization was only starting to kick off then, we also saw an unpredictable production in terms of goods that were being produced. At the same time, agricultural hubs were emerging in key locations around the central USA in places like Buffalo and Chicago. If you look at this chart, if you look at this picture over here, you can see that where Chicago is located is right in the middle of the USA. From coast to coast, from the west coast to the east coast, Chicago, Illinois is centrally located not only in the United States, but is also centrally located to all the Great Lakes, to the Mississippi River. And these were production hubs, right? They were economic powerhouses that were coming up. And Chicago, being centrally located, became a central marketplace for agricultural trade. What came with this also was the building of transportation hubs, such as canal and railroad development, all being centered and linked through these Great Lakes and the Mississippi River, and centralized in Chicago. And that's what brought about the Chicago Mercantile Exchange, or the Chicago Board of Trade. And these exchanges helped introduce standardized futures contract for market stability, right? And the CME, or Chicago Mercantile Exchange, was introduced to standardize grading, quality, implement rules of trade, and having time contracts. Now, moving on into the new century, the 20th century, we saw an expansion of futures contracts beyond agricultural commodities. This is what we know today as derivatives, a derivative of an underlying asset. Now, the story that I want to tell you from this is the art of trading. During the creation of Chicago Mercantile Exchange and the Chicago Board of Trade, at the boom of this economic activities, you had the exchanges. But because these exchanges were there to facilitate trade and the exchange of securities and futures, they required liquidity. They required a third party in order for large financial institutions to facilitate their trades. Now, what were they? Well, they were pit traders. And pit traders operated in a form of what we call an open outcry. Now, there's different types of pit traders, okay? And these pit traders provided liquidity for the big financial players, like the banks and financial institutions who borrowed and lended securities from the big companies, such as the railroad companies that were present there, those big agricultural companies, oil companies as well. And the pit traders function as an independent third party, so to speak, to facilitate liquidity. And during the genesis of pit trading or open outcry, all the way to the 2000 era, this strategy was very straightforward. The speed traders acted as market makers, or more realistically, dealers, for the smaller orders that would come from these financial institutions. Their role was essentially to break down large lot orders from major firms and banks, and then distribute them to brokers and executing smaller trades. Okay, so in other words, they operated as middlemen for these financial institutions and firms, and they would be buying in bulk and selling in smaller portions while capturing a small gross profits in terms of margins. All right, so and typically from a bid and ask spread. So this approach worked really well because the market had a steady flow of buy and sell orders coming in from both directions. So again, pit traders function as liquidity providers, right? So imagine if person A to person B wants to transact with each other, they want to buy something from each other. Person A wants to buy something from person B, for example, but they only have $50, and yet the thing that person A wants to buy from person B only costs $10. So what do? They need to have a third party in order for them to break their $50 into a smaller change or a smaller denomination. So this is what pit traders did. They were the third party who's able to take that $50 and break it up amongst themselves, trade it amongst themselves, and with other smaller financial players like brokers and so forth, and make a small profit through the big bid and ask spreads of those securities or futures that were traded. And that's how they get the profits. And by the time these orders were broken up, person A and person B would be able to transact because that $50 has already been broken up into smaller pieces. So that's what pit traders did. They function as liquidity and they provided market efficiency. Now, moving on into the modern era, past the era of 2000 going to 2015, because 2015 is when pit trading ended. We have a transition into pit trading into electronic trading, okay? And there was an so-called evolution that happened, which came in the form of a changing order flow. So instead of having a steady supply of buy and sell orders coming in from established major financial firms, right? There was instead a one-sided market, okay? There was an order flow to large one-sided market waves, right? And this made it very difficult for the locals, which is the pit traders, to act as middlemen. See, they can no longer offload their positions in an effective way, in an efficient way amongst themselves. Okay, so this transition from this pure order facilitation prompted them to take a different kind of approach, which is a more directional trading approach. So now traders would develop a market bias based on strategies like auction market theory. So instead of trading both sides of the spread, they position themselves within a range that aligns with the bias, a range being two different reference points in price. Now, the impact in terms of the duration as well went from a short time frame to a much longer time frame, something that they used to held among themselves between minutes, sometimes seconds. Now they have to hold on to the trades for a much longer time frame, right? Such as the longer portion of a trading day, for full trading day. Now, a small word on this. Is there an edge or an advantage in pit trading? Well, some might say yes. Obviously, the pit traders themselves would say yes. And they were very apprehensive about moving into electronic trading. But we can see now that there are actually no inherent advantages over screen trading. Okay, and transitioning traders, there are so many stories out there that you can read about and you can watch online, where many of the successful traders who traded in the pits in open outcry had a lot of difficulties to transition into the computer trading era, the electronic trading phase. Many of them actually fell into depression, and instead of making hundreds of thousands or millions at any given point, they couldn't do it, and they had to revert into taking up other jobs, retail jobs and normal jobs that where no trading is involved. And it's a sad story, but it is what it is. And where we live today, there's obviously no pit trading. We are purely electronic based traders, but there are some key differences where pit trading excels or is an advantage compared to electronic trading. So pit traders, typically when they're in the pit, they can physically observe the brokers, firms, and other pit traders or locals, and they can gauge what the order flow would be, what the sentiment would be in the markets. It's live, it's right in front of you. You can feel it in your bones, you can feel it in the air. And that was the sort of atmosphere and experience that pit traders had in order for them to trade well. And that's, ironically, that is the exact same reason why most of them fail to make the transition into the electronic trading era, because none of that obviously existed. You would sit in front of a computer and you would look at the chart, and that was it. Okay, so when having said that about pit trading, I want you to have a look at this documentary called Pit Trading 101, which was released in 2013, 2 years before pit trading ended completely. It was shot by Jonathan Hoening, which is a managing member of capitalist big hedge fund, and he was also a floor trader at the Chicago Board of Trade. If there's any film on trading that you have to watch, it's this one. If it's the one film that you have to watch throughout your entire trading career, I would highly recommend you, as my mentees, as my students, to watch this, because not only does it gives you a sense of what bit trading is and gives you a very basic rundown of how trades were conducted within the pit, it also shows you the high levels of standards that traders used to have. And that's something, as a trading mentor, that's something that I really wish to emulate in my teachings, because I really want to elevate trading as the craft and trading as an art form. You know, a lot of what we see today, I feel, is a lost art. You know, if you go on social media and you look at all the things that retail traders talk about, it's mostly funny things, funny memes, and it has to do with losing. It's funny. I enjoy it. I really do enjoy it. It's entertaining, you know, and it's meant to have this sort of solidarity of, yeah, we're all in this together, and you know, we'll make it together. Well, I have a different perspective on that, because again, as a lawyer and an anthropologist, I like to look at the origins of things. And you could see the philosophy and the way that these bit traders operated back in the day. Some of the things they talked about in the earlier parts of the film is that you are on your own, right? And you are the only CEO and employee of your company. It's you incorporated, right? And they also talk about, you don't care about what's happening to the next person. You don't care about what's happening to other traders and the things that they're talking about. You only have to think about you, and you have to get better as a trader. This is the level of mindset that I wish to cultivate amongst my mentees, right? If you're my mentee, I don't want you to be listening in on any of those things that you come across social media. Those things should be toxic to you in your early stages of learning. You want to just cut that out completely from your life. And you should focus only on the things that I will be teaching you in the private mentorship program. I want you to cultivate a very professional level mindset that has a high standards of discipline and excellence. And again, it's not something that I see prevalent in the retail trading space, and even in professional trading spaces as well, where supposed trading professionals talk about trading. I haven't come across anyone in the last 5 to 10 years, maybe more, who really has that caliber and standard of what used to be the standard and what used to be practiced in the past, maybe in the early mid to late 90s. To me, those were the final eras of good trading, good art of trading. So if there's any film that you're gonna watch, it's this one, and I highly recommend you to watch them. Now, I've adopted a lot of these things into my own way of trading. I blend an open outcry or bid trading together with electronic trading. Okay, and a lot of the way that I trade is based on techniques that were used in bid trading. So typically, a bid trader, they would prepare for the next day at night. They would prepare for the next day by studying the previous day price open or close and close, and or the previous few days or weeks open and close. That's all they needed. And when they go into the pits the following day, all they have would just be a pencil and a notebook stating the previous day's open and close. That's all they needed. So this gives them a range that acts as two reference points for them to frame their trade ideas around. Even so, this technique, as you saw before, has evolved with the advent of a more complex and ever-evolving market, as well as the obvious introduction of electronic trading. Now, I started out my trading journey when I really learned how to trade. I started reading this book called Street Smarts. It was a book written by Larry Connors and Linda Raschke. And that was the first time where I saw that there is a system and a method that is strategic, logical, and at times mechanical in trading. There is a process and art to trading, and there's ways to utilize resources in order for you to get better as a trader. Things like using historical price action. What is it in historical price action that is important and should be utilized by you in your trading? I began to learn that there were different kinds of strategies that were employed by traders, and on the flip side, there were also different kinds of strategies to inverse those said strategies, where you could do the opposite of whatever that was prevalent at the time. And it really opened a much larger world for me. It opened my perspective. Prior to that, all I have known is Benjamin Graham's Value Investor. That is the book that was taken to heart even today by people like Warren Buffett and Charlie Munger, two of the most probably well-known traders or investors in the world. And that's all I knew too. I thought that technical analysis was just a myth. It was not real. It was not true. And looking at fundamentals and looking at the valuation of companies, for example, in terms of stock, the underlying fundamental basis of those assets was the most important thing in order for you to do trades. So, like most people, I learned how to do valuations of an asset, to establish the net present value, to come up with the discounted cash flow, calculate the PE ratio, all of that stuff. And when I discovered that I wasn't doing that well in utilizing those knowledge in my trading, where the companies that I do in my calculations would show strong indication of a buy, where I would invest in a company with the anticipation that the price of that asset, of that stock, would go higher. Most often than not, that wasn't the case, or that was the case, but it took 3, 4, 5 years until it yielded something. And that was something that I just didn't have patience for. So when I found out about street smarts, I found out that, wow, there are certain things, methods and techniques that are completely different to value investing. And there's so many different kinds of other figures other than Warren Buffett and Charlie Munger that are actively trading and investing. And each one of these individuals had their own way of doing it. So I started to think maybe I could use these different techniques and tailor make them to how I am as a person and how I approach the markets. So in my study of street smarts, being the lawyer and anthropologist that I am, I began to deep dive into the material some more. I started looking at Larry Connors and what he came from, all the mentors and knowledge and materials that he used to go through in his early trading stage, as well as the other co-author Linda Raschke, and what she used to, well, what formed her basis as a trader before she wrote this book with him. Now, when I looked into Linda Raschke, I found out so many more things about trading that I didn't get from the Street Smarts book. I found out that a lot of her understanding of price and markets was based on the Taylor trading technique that was written by this gentleman called George Douglas Taylor back in the 1950s. So that's part of the beauty of embarking on a trading and learning journey. Trading and markets and price and the industry, it's like a big onion. And the more layers that you peel, the closer you get to the core of what it is. Okay? And I soon discovered that there's plenty of things in trading that I can use to utilize and blend together in order for me to form something that's unique to me. Now, having gone through so many of materials that I haven't fully described here because I can't, I'm only using this example of the street smarts and and deep diving and discovering more about it. I've discovered that a lot of this knowledge, they seem to converge on 3 basic concepts, which is liquidity, market efficiency, and the open high low close or open low high close, or in other words, price. In my opinion, these 3 tenets are the most important ingredients that a trader must have in terms of understanding and having mastery of. And everything else is only a subset of these 3 basic tenets. Now, I'm sure most of you or some of you have gone to seminars organized by firms or expos where you will see a practitioner, a trader, talk about things, and I'm fairly certain by the end of the talk, you don't really understand what you're talking about. They're using a lot of big words, a lot of technical jargon, but none of them really stick to you. And going back to what I said before of the state of trading space, the industry and the markets now, and what one would normally come across in the day-to-day trading space, I think this is another thing that I feel a bit saddened about, because it's got to a point where it's overtly complicated. I know for a fact that a lot of these traders who talk at expos and events, when they use those technical jargons and overcomplicate the things that they talk about, I know for a fact that they don't really know what they're talking about. Okay? I know what I'm talking about because I'm able to distill what it is down to its pure essence. And how I got to there is looking at how things came about, the origins of how liquidity came about, what was the need for it, what is price efficiency, and how do traders trade. So these are the three basic tenets that, to me, is the most important tenet that every trader should have. Now, having said that, to use an analogy of alchemy. So, if you don't know what alchemy is, alchemy is the art of changing base metals into gold. And the people who did this were called alchemists. Now, if you look at those three basic tenets of trading, which is liquidity, market efficiency, and price, would you be able to turn a rough, crude thing into something that's valuable? Would you be able, as an alchemist, to turn base metals into gold? Now, if you know the history of alchemy, you know that a lot of these alchemists failed to do that. Okay, and they failed to do that because they didn't find a secret ingredient in order for them to achieve making or transmuting gold. There is a hidden ingredient in the art of trading that links or bridges all of the three tenets together. This missing link is able to explain those tenets logically. Okay? And again, using the alchemy as a metaphor, not having this ingredient is the reason why most people fail to turn trading into a consistent and profitable profession or craft or an endeavor. Now, if you want to use a different analogy, something that's more contemporary, this missing link could also be, to use quantum physics as a metaphor, this missing link is similar to the Higgs boson, right? A Higgs boson is what they call the God particle. It can explain the characteristics and behaviors of particles, but it's something that's discovered in only in recent times. And the effort that human beings went through to discover the Higgs boson was colossal. They had to build the Hadron Collider in Switzerland, the only one of its kind in human history, and create the Higgs boson, because it's not something that is naturally available in our world. Scientists or physicists, they knew that a lot of what we know about physics and quantum physics and the way that our world works, we only know parts of it. But there has to be something that links all of our knowledge about particles and atoms and, you know, how things work, that they cannot figure out. So they had to replicate it, right? They have to artificially create it in order for them to explain it. And when they managed to do so, they did find out that yes, there is this thing called the Higgs boson, and it is the missing link that enables the physicists and scientists to explain things away. So they're able to use that missing link in order for them to advance their craft, or, well, in this case, physics or quantum physics, and to move it forwards. Now, I've discovered what the missing link is. I know what it is in order for me to use those three tenets, bridge them together in order for me to make the most precise and consistent trades possible. I'm able to look at a chart and I know exactly what price is going to do, where it's going, and what do I do in response to that. In fact, I don't respond, I anticipate. I know what's going to happen, so I know what to do. Now, I can teach you this if you join the private mentorship course. I will give the keys or the missing link or the Higgs boson to you in order for you to fully realize your potential to become a consistent, disciplined, strategy-oriented, and discipline-oriented trader. And all you have to do is go to the website, which is ninefoldsystems.com, and sign on to the private mentorship program, which goes on for 3 months. We'll be doing 2 classes per week, which ranges somewhere between 2 to 3 hours. It will involve very practical teachings and lessons, which will make you a better trader with every single class. Now, there's still a few more slots available, so if that's something that you're interested in, then please go to the website and sign on to it. Now, I want to be going back to price, because we've already looked very briefly at where the concept of liquidity comes from, as well as market efficiency. And then we also saw that a lot of the trades that I make come from bit trading techniques. And I used those techniques and blended them with electronic trading techniques and discovered that there's a lot more to it than that. And one of the things that utilizing bit trading techniques into the electronic trading is looking at the chart, which is the candlestick chart, which in the first complementary lesson was the bar chart, and discovering that there's an open, low, high, close, and there's an open, high, low, close. Now I will show it to you after this slide, other resources that were present in and that has always been present in all forms of trading resources. That shows you the open, high, low, close, but not in the form of a chart. But looking at this slide for now, we can see, as I mentioned before, the open, high, low, close and the open, low, high, close is in different time frames will reveal a better picture of price behavior and understanding of bias, which in this case, in the image that you see on the right, is the daily bias. We can use the knowledge that we have of the open, high, low, close or the open, low, high, close to our advantage and use it in our trade executions. So knowing the characteristics of an open, high, low, close or an open, low, high, close can enable you to know when to enter and exit trades. Okay, now let's look at how we can utilize our understanding of the open, low, high, close or the open, high, low, close in the context of our trades, specifically when to enter and exit trades. Now always remember that the open, high, low, close or the open, low, high, close is price that is represented in the form of candlesticks on a chart. Now, knowing the basic characteristics of price will give you an understanding in how to manage your trades from a technical point of view. This understanding will give you your confirmation of your bias, whether you're bullish or bearish on any given asset. It will give you greater clarity in executing and managing your trades based purely on price action alone. You don't need any indicators. Now, if you look at my chart, you can see that there are no indicators at all. It's just a naked chart. And this chart is a 1 minute chart where each one of these candlesticks represent 1 minute. Now, the trade that I'm about to show you will be classified as an intraday trade. Now, there are many types of trade that you can make, which definitions I will cover in both the complementary lessons as well as the private mentorship. But for this trade, I want you to assume that you have a bullish bias for the day going into the new week. What do I mean by that? Let's say that, well, we're looking at Monday's 17th of February 2025 opening price here. That would be the opening price because you see it's a green candle. It opens there, makes a low, makes a high, and closes there. So that would be the opening price. Okay. Now over here on this side, on the left side of the chart, this will be the previous day, which is Friday, the 14th of February 2025, Valentine's Day, which also would be the previous week. Now, if you assume, let's just assume that you have a bullish bias going into this new week on Monday, okay? And you see that price opens way below the previous day or previous week's close or settlement. You can see that price opens, makes a low, and then makes a high, and then it closes, right? So knowing an open, low, high, close without looking at a higher time frame, without looking at a 1 hour time frame or 2 hour time frame or 4 hour time frame or 20 minutes time frame, any of the time frame that is higher than in 1 minute, which is what you see here in the chart, you would already know that it's going to be a bullish candle from 10:30 to 12:30 p.m. Okay. So how do we frame our trades? How do we enter and exit our trades knowing that we're bullish? Okay. And knowing that we want to do an intraday trade. Okay. What we do is that what we want to do is, as soon as price opens and we can see that it makes a low here, right? And then it starts moving higher, we can start buying our positions long in any one of these areas that's below the opening price. Because as soon as it opens at 10:30, even though it rallies higher, then it expands lower, right? We already have a bullish bias and we know what makes a bullish candle, which is an open low. Therefore, what follows after an open low? It's going to be a high. Okay, so we want to be buying our positions long in any of these candles here that's below the session or AM session open. And if you see, when price rallies higher, it retraces back lower below the session open, the AM open, AM session open here. Over here, we can either add to our positions, which we've opened all of in any of these areas below the AM open, right? Or if you've missed all of this, right? This retracement gives you an opportunity to enter here if you've missed buying your long positions here. It gives you the opportunity to enter long there. Because why? Because these areas here would be below the AM session open. And look what happens after it goes up, makes a high. Okay, so if you were a scalper, right, and if you bought here, you can already decide when to exit your trades in any one of these areas up here. Okay, but because in this example we're going to be utilizing an intraday trade setup, we want to be holding. Okay, and what price is telling us is already giving us an indication, right, that it's going to be bullish throughout the day, because you have an open, low, high, and look how high that high is compared to where the open was. The proximity of it, right? It's quite far. And where does it close? It closes there. Let's assume that we bought our positions long here or here, right? And we hold on to our trades. And we're still bullish, right? Now, if you're bullish, what you want to be looking at using the open high low close or the open low high close understanding is that obviously we want to be looking at price to move beyond the previous day closing price. And look what happens when the FCP OPM session starts at 2:30. It does indeed open, retraces back down, and closes there. If you had your tick position, you'd already immediately be filled in for an exit right there. Simple, isn't it? Now let's look at what happens throughout the day, because we're utilizing a intraday trade setup and we want to be holding for longer. If you look at the previous week or previous day's close, you can see that when price dips below the close, right? And because we're bullish, right, we want to see a opening, right? Sorry, an opening. That would be the opening of the PM session. Let me just draw that out for you. Opening. Is it below the open? Yes. Any one of these areas here would be below the open of the PM session. But look what happens when it price goes below not just the open of the PM session, but also below the previous week or previous day's close. It's an optimal place for you to enter long there, or add to the longs which you've already entered here and here, right? And assuming that you haven't closed and you're still very bullish, you're holding on to your bullish bias, you can add to your position there, and look what happens. Price rallies higher. Okay, so you can utilize just a very basic but fundamental understanding of the open, low, high, close, right? Or the open, high, low, close principle in order for you to know when to exit and when to enter and exit trades. So if you are bullish, you have a bullish bias, what you're going to be looking out for is this. When price has an open, you're anticipating what? You're anticipating that it goes low, right? And anytime that price goes lower than the opening price, that's when you start piling on your long positions. And every single time when price goes below the open, that's an opportunity for you to add to your positions or enter into a new position if you've already missed opportunities, the early opportunities that price has presented to you, and enter there, right? And if you were a scalper, right, you can immediately exit in any one of these trades. Any one of these candles you can exit. But if you're an intraday trader, right, and you have a very strong bias where price is going to rally higher, it's going to be very bullish moving on into the following trading session, which is the PM trading session. You want to be holding on to your trades, and as soon as price opens, you'll be filled for an exit. Or you can hold on to them because you're really bullish, and you can buy positions long under the opening price of the PM session, all of this. And if it goes below, as an added bonus of the previous day and the previous week's closing price, you can add more position or start a new position long there and exit accordingly. Okay, now let's cycle up to a higher time frame, which is from a 1-minute chart to a 15 minutes chart. Over here, we can see the exact same annotations that shows us that is the AM session open, right? Makes a low, makes a high, makes a close for 15 minutes because each of these candles represent 15 minutes, right? And that becomes a up close candle or a bullish candle because there's an open, low, high, close. Okay? Now, if you remember what I mentioned in the previous 1 minute chart, where we see an open, low, high, close, and we can see the next following candle, open, right? Goes low, below the previous candle's open, or the AM session open, we can add our long positions there, right? And we can hold on to that, knowing that we have a bullish bias, and exiting there where the previous day close or the previous week's close or settlement is, because we want, as having a bullish bias, we want to be seeing price go at least above the previous day close. Okay, and if you see under the previous day close, when price dips below it, right there, we can continue adding to our long positions and hold on to it as the market rips higher. Okay, folks. Now over here, you can see that we have an opening for the present day, Tuesday, 18th of February, 2025, where we have a market open here at 10:30 a.m. Here you can see a down close candle where a price open, goes high, low, and close. That makes it a down close candle. Now, that would be the opening price, but I have a bearish sentiment going into the day. So what I did was I shorted it. Now, just bear with me while I annotate the chart to show you what I mean. Over here, this would be the opening price. Now, price hasn't yet gone back above the opening price. So what I did was I shorted it before the market is presently where it's at currently. Now, when you saw me begin this session, recording this session, I was up about $54, right? And I could have taken a profit. But because I have a longer time frame, which is a longer trade time frame, which is I'm looking for an intraday trade, I am looking for price to hit lower from this point. And where am I targeting? I am targeting the previous day AM session close. And if you can see, the close and the low that was created here is not that far off. So I could have taken profit closer to it. But I just wanted to show you exactly, based on my understanding of the open high low close or the open low high close, i.e. how price behaves, blending that with my bias of a lower price delivery for FCPO or palm oil futures later in the day, I'm holding on to my short position and seeing whether it will give me that target where price will be going lower later in the day. Now, price may still give me an opportunity to add to my trades, where anytime that it goes above the opening price, I would add to my short position. Now, why is that? Because I'm expecting lower prices, utilizing my understanding of the open high low close or the open low high close. I want to be taking a short position above the opening price. If you look at if you look at the 15 minutes chart, you can see that price is heading higher, right? Price is heading higher. But if you look at a higher time frame, let's say on a 1 hour time frame, right? I believe that if price were to trade above this opening price, and if I were to take short positions above the opening price, which is what I'm going to do now actually. There. I believe on a day time frame, it's what you see here, right? Price is open there, headed upwards, and I think it's going to retrace lower. Or it might not, because it already did go to the previous day's AM session close. But for the sake of demonstration, I just want to show you how you would do it in a live setting. Can you see how price just stops right below the opening price there? And you see it's losing its strength and momentum and heading downwards. Now, in hindsight, I should have taken into account the spread and put the added short position exactly where my entry would have been to account for the spread. But because I want to average, down in terms of my earlier position, right? Because of that, I wasn't filled when price hit that opening price there. But we will see if price gives me an opportunity to add to my short position, where we can aim for the low of the previous day's AM session close. All of these things in terms of spreads, where to aim for, what the stop loss placement would be, I will teach in greater depth and greater detail in my private mentorship program. As you can see, the price seems to be panning already in our favor. Now, for demonstration purposes, I don't think we'll have time to wait for the remainder of the day until the markets give us what we want, where price will go to the targets that I set out for. So I'm going to be giving a very low threshold of target, which would be here, and which will yield us well, close to $62 in gains. And let's see whether it gives us that. Now, this trade is something that I wouldn't necessarily do, because in terms of the risk and reward present, you can see here, if my short position, which I entered here, putting my stop up there, and down there yields me a 1-to-1 ratio, an RR, a risk and reward ratio of 1-to-1. Personally, for me, I need to have a minimum of 2. Now let's jump back to the higher time frame, and let's go cycle up from the 1 minute to the 5 minutes. Now over here, you can see that price has open, made a high, distribute lower, making that low that is close to the AM close. And if you notice, it hits also the candle, the last candle here during the AM sessions, open. The open and the low of this candle. So that could also be considered utilizing the open high, low, close principle, right? Why? Because when you see price giving way all the way down here, it's delivering to a reference point, which is the opening of the last candle in the previous day's AM session. Previous day's AM session. So that would be considered a valid trade as well. In fact, I really wish now that I'd taken that trade. And but because I was preparing the slides for this presentation as a whole, I missed the trade. So we'll see if price will indeed go to this very, very low threshold target of $61.77. Now let's cycle up to a higher time frame. Let's cycle up to a 15 minutes time frame from a 5 minutes time frame. We can see here again where price has indeed expanded upwards. The following candle has opened there, made a low there, expanded higher, and we have still about 3 minutes and 10 seconds until this candle will show us its close. Now, what do we want to do? Because we're already in profit, right? We're already in profit. We want to go we want price to hit towards our target. and we want to see how this candle closes based on our understanding of the open, high, low, close, and we want to see what the next candle's open would be in relation to this candle in the 15 minutes time frame. Now let's cycle back to the 1 minute. Okay, so now as you can see, that price did indeed go exactly to our target, and our, well, low threshold target, but because we're on delayed data, it doesn't register as our our execution is being filled. It will register it in, I don't know, in next 15 minutes, I think. But just for the purposes of this, I will close my trade here to show you that indeed panned out exactly as how I planned, based on my understanding of the open, high, low, close, where I have a bearish bias, and any sort of movements of price above the opening price, I want to look at shorting it. Okay, and I can close my trades if I was a scalper anytime below the opening price, because I know on the higher time frame that price, say on a 15 minutes time frame, you can see that price opens there in close proximity to the opening price of the previous candle, retraces up, makes a high, and therefore what am I expecting? A low after that. So it indeed goes lower, and eventually it's already made a low there. We'll see if it goes lower than that. I think it will, and it will close close to, well, in this case, the low of this candle. Now I'm still expecting bearish prices, where bearish price delivery, where price to expand lower throughout the day, but just for the sake of being, well, efficient with the time that we have in this presentation, I just wanted to show you the principles of having a good understanding of the open, high, low, close and the open, low, high, close principle, that on a very simple principle and understanding, you'll be able to know when to enter and exit trades. So I've shown you, just by having a deep, meaningful and fundamental understanding of the open, low, high, close and the open, high, low, close, will enable you to enter and exit your trades. Now, there's a lot more to it than that, but just based on this fundamental understanding of price and its behavior, you'll be able to already anticipate where price is going, therefore enable you to understand what and when to enter into your trades and where to exit them. There's a lot more to it than that. And there's a lot more for me to teach you. But if you want to learn more, then head over to ninefoldsystems.com and sign on to our private mentorship course, where I'll be able to teach you more concepts in order for you to blend together, just as how I blended together all the teachings and knowledge that I had from multiple resources, by finding out what those knowledge came from, where they originated from, and how it evolved to what we know them today. And having that hidden and missing link enables me to trade efficiently, consistently, and profitably, so to speak. And you can see, just by having this one concept, just this simple, fundamental, and basic concept of the open high low close or the open low high close, you can already trade. And everything that I'll teach you in the private mentorship is another technique and another factor that you'll be able to add to your tool of arsenal in order for you to become a consistent trader just like I am. And not only that, you'll be able to strategically frame your trades precisely on when to enter and when to exit them as well. So if that's something that you're interested in, please go to our website, ninefoldsystems.com, and sign up to the private mentorship now. There's a few places still available for this time being. And thank you so much for your time, and I hope you learned something insightful and new today that will enable you to trade better. And I'll see you in the next complementary and supplementary lesson that she'll be releasing soon. Thank you. And remember, stay safe out there and good trading.